I've been helping people with their finances in a bunch of different ways for over 20 years, and I see beginner investors make the same mistakes time and time again. In this video, I want to cover the biggest mistakes that newbie investors make and show you how you can avoid making them. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based here in the UK, and I've been putting out videos on YouTube for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. Now, whenever we try anything new, we always make mistakes. It's how we learn most effectively. The problem is, when it comes to investing our hard-earned cash, we obviously want to keep those mistakes to a minimum, both in terms of the number of mistakes that we make and obviously the amount of money that they cost us. And if we can avoid them altogether by watching a super helpful YouTube video which has chapter markers in the description, then so much the better. Okay, let's get going with investor mistake number one, which is running before you can walk. Now, like most things, investing is a process with different levels of nuance. You can approach it very simply, or you can go really deep, and it can even become a full-time job. Now, I often see people want to dive in and get super technical right from the start, and that rarely ends well. So they will read books and learn about PE ratios, alpha, all that sort of stuff, and they will try to build the, quotes, perfect portfolio. And then they'll wonder why it isn't performing perfectly. I mean, they did everything right, so why isn't it working? Let me be clear right from the start here. Success in wealth building is about being invested, first and foremost. It's about owning real assets that will grow over time. Everything else, your asset allocation, your chosen markets, all that other stuff is just nuance. It won't make that much of a difference at the end of the day. Being invested will. So you overcome this mistake simply by getting started. Just buy the simplest investment you can, which is a global equity index tracker fund, and get started. Then you can learn on the go, watching what actually happens in real time, and if you want to, adjusting accordingly. Mistake number two is trying to time the market. Right now, some stock markets around the world are at or are approaching record highs. And this leads to the understandable thinking that you should wait before investing. I mean, you don't want to get in right at the top, do you? But that's actually illogical, because who's to say it is the top? If you wait and the market goes up another 20%, you will have missed out. Markets will continually hit new highs. They have done since forever. So you can overcome this mistake by just being brave and just getting the investment made. But I know that's easier said than done, particularly if your desire to try and time the market is due to your unease that it might go down. So you can overcome this by pound cost averaging or dollar cost averaging, by paying into your investment regularly. Or if you have a lump sum to invest, by dividing it into smaller chunks and paying those chunks in over a few weeks or even a few months. Now, mathematically speaking and historically speaking, you will almost certainly be better off by investing in one go. But if it makes you more comfortable to spread the investment over time, then do it. That way you will average out the ups and downs of the markets just a little bit, and that's way better than waiting or even not investing at all. So how are we doing? Have you recognized any mistakes that you have made yet? If so, let me know in the comments. But if I had to bet, I would say that number 5 is the one that you're most likely going to resonate with. Mistake number 3, tinkering. Let's say you do make the investment and you watch it really carefully and you think that maybe you can tinker with it a bit in a bid to optimize things. You maybe swap one fund for another, or you move your platform or whatever. Well, that, folks, is tinkering, and it's a textbook rookie mistake. By tinkering and fiddling with your investments, you're likely to do more harm than good. By switching funds, you will be out of the market altogether by anything up to a few days, and you might incur some costs. Costs are obviously a drag on your performance, so you need to keep them to a minimum. So my suggestion on how to overcome this, well, place your investment, get it in, and then walk away. Don't even look at it again for at least 3 months, and ideally longer. Try for a year. Or if you feel like you just have to look at it, simply make a decision that you're going to give it time to settle in. And even if you look at it, resolve not to change anything for at least a year. Not easy, that one. We love to tinker. Mistake number 4, taking too little risk. And oh my gosh, is this a big one. I totally get it though, right? If you're a new investor, your understanding of risk is abstract. It's based on theory and reading, watching videos like this, and not on experience. So it's understandable to want to play it a bit safer. But actually, if you're investing at all, you should be investing for the medium to long term, at least 5 years, and probably multi-decades. And when you bring together risk and time, well, that's when the magic happens. So I've done other videos on risk. I'll put one up here and another couple linked below the video, because it's a really important subject that you need to understand. But if you're worried about what level of risk to take when you get started, choose a fund which is labeled something like balanced or medium risk, something like that. And that usually means a fund with about half invested in equities and half in other stuff. And it won't be too hairy while you're getting going. And then as you get more comfortable and more experienced, you can dial up the risk. Don't be shy, but don't freak yourself out either. That serves nothing. Again, you're going to be investing for a long time, and it won't harm your future to ease into things a little bit. So taking too little risk is a mistake, but it's okay in the very short term. Just learn quickly and push it harder as you become more experienced. Mistake number 5 is overthinking. Now, maybe you've got the sense in the first 4 mistakes that we've covered that the way to overcome them is to err on the simple side, at least initially. That's definitely true, right? The antidote to almost every investing mistake is just to start, then to keep going, and while you're keeping going, don't fiddle, don't tinker. Overthinking really is the daddy of all the investor mistakes, and it comes in lots of forms. Some people, like we said in the very first mistake, will let perfection become the enemy of done. And they don't get started before they think they can build the perfect portfolio. Other people overthink about what the market or the economy or the government might do, and they delay investing until they feel better about whatever it is that they're worried about. But there's always going to be something to think or worry about, so they never actually get started. Finally, still others will overthink about what everyone else is doing, not wanting to get it wrong, as if there is a perfect right way to do it. To avoid overthinking, keep it simple, but keep learning, observing, and building on what you learn as time goes on. The best way to learn, remember, is by doing, not thinking. So don't overthink, do. You know what? We're having fun here, so let me give you just a couple more quick fire mistakes and their solutions. So number 6, thinking too much of early wins. So you've invested, the market soars, you add 10 or 15% to your portfolio in a short time, and you think you're a genius. You think that the investment decisions you've made, these are the main reasons why you're doing so well. Nope, you're not a genius, you just got lucky, could quite easily have gone the other way. So don't drink your own Kool-Aid, as the Americans say. Be grateful that you got lucky and keep going. And finally, mistake number 7, ignoring costs. Even if your investment is small to start with, don't ignore costs. You will incur costs on the platform that you use to invest your money, and you'll incur costs in the funds that you choose usually. Every pound that you spend in charges is a pound which is not growing for the future, so you need to treat this seriously. Look at the charging structure of the platform you've chosen. When the pot is smaller, you're likely better off paying a percentage-based charge. But still, look for a low-cost percentage-based charge if you can. As the pot grows, you may well be better off choosing a fixed fee platform. Also depends on what you're actually investing in. Is it funds, ETFs, directly held shares, or what? I would stick to low-cost passive tracker funds and ETFs to keep your costs right down. So there you have it. 7 beginner investor mistakes and how to overcome them. Let me know in the comments if you have fallen foul of any of these mistakes. I know I have, and how you overcame them. And if this video has been helpful, you know what to do. Hit the like button, subscribe to the channel if you want more where this came from. Thank you so much for watching, and I'll see you in the next video.